So Fed holds interest rates steady and telegraphs that there's going to be 3 rate cuts coming in 2024. We're also seeing builder confidence grow. We're seeing new mortgage applications increasing. We also see that home buyers feel that there's a magic rate to get back into the market. So we're talking about all this today with our good friend Brent Starts, so don't go anywhere. Hi, my friends. It's the first time you've been to my channel. My name is Lee Bricky, and on this channel, we talk everything real estate in Palm Beach County and the Treasure Coast. So if any of that interests you, please just tap that subscribe button, ring that notification bell so you don't miss any of our real estate tips and tours. We really appreciate it. It really helps the channel, and you don't miss any of our content. So with that being said, let's bring on our good friend, Brent Starts. All right, Brent, how you doing today, man?
I'm doing great. How are you, Lee?
I'm doing great. So we are back for the first video of the new year, 2024. If you follow this channel real quick, my wife had hip surgery. It went bad, the first one. It was just for a tendon. She ended up having to have a full hip replacement right over holidays. So it got pretty crazy over November and December with me taking care of her, trying to run the business. So if you follow the channel, I apologize for not having a video up for a couple of months, but we took a vacation also. And so we just took a little bit of a break. We'll try not to let it happen next year, but we're back this year to talk about what's happening out in the market. And we brought our good friend Brent Starts on with us to answer some important questions about where we're going to end up this year with the rates and with loan limits, and also where the market may be heading here towards the end of the year. So with that said, Brent, let's get going here. So Fed's put out a article in mid-December. Fed holds rates steady, indicates 3 cuts coming in 2024. And then also Fed officials see slowing, which is Christopher Waller. He's a Fed member, and he says that the inflation will continue falling this year back to the Fed's 2% target level after 2 years of accelerating price spikes that hurt millions of Americans and households. And with that news, we're seeing builder confidence growing and interest rates declining. So let's talk about the Fed first. Where do you think that they will be with this? Because I'm hearing some investors out there and experts saying that they could see a up to 6 rate cuts this year.
Right. I think the consensus is about 4. Seems to be the average at this point. And of course, all of this is data dependent. As data comes in, we're going to see inflation drop because we know the higher month over month figures are dropping off, the ones from 12 months ago. So that year over year is dropping. We know it's going to go down. It's not a mystery. So that's what they're doing. They're making those adjustments, knowing that this is what's going to happen. They're going to do at least 3, I believe 4 cuts. Now, as far as mortgage rates, how that relates to mortgages and our market and what we do, the rates are already starting to drop with anticipation of 3 to 4 cuts, right? So we've already seen where interest rates on mortgages drop, just under 8 to the, we're in the mid 6s right now. We just locked one today in the mid 6s. So it's already, kicking in, which is exciting.
What do you think if they do start cutting rates, because rates have fluctuated a little bit over the last few weeks. So where do you think that if they start cutting rates, what will happen to mortgage rates? You think that's already baked in, or do you think we'll start seeing a continued decline?
Great question. It's not fully baked in yet because there's so much data dependent, decisions that need to be made over the next, actually the March meetings, what people are thinking as far as the first cut. That's what's in the cards right now. That's what people are anticipating. The market's anticipating. Right. I'll give you an example, something that's really, consumer sentiment came in today, for example, came in a little hotter than expected. So and consumers are more encouraged because the rates have dropped recently and for housing, mortgages, that type of thing. It's a little surge there. But, actually next week, we're going to auction the federal government, the U.S. Treasury is going to auction over $160 billion of debt in 1 week. Now that's something that's going to impact interest rates. So we're locking loans, anything closing in the next 2 or 3 weeks, because that additional supply, it's going to be a temporary thing, but that's a tremendous amount of debt for the markets to sop up. In other words, that debt has to be sold or we shut down the government, right? We have to sell
Right.
that debt. So to attract the investors and institutional investors off the sidelines, they've got to raise that interest rate to attract them off, and it's an auction. So until those treasuries are sold, we go into the same market. We're talking the same investors from the Ohio State Teachers, Retirement Fund, the IBM Pension Fund. I mean, all these investors, State Farm Insurance, all these institutional investors are looking at like, hey, should we get mortgages and not, or should we get U.S. Treasuries? And so there's a push pull there. And I think we could see rates tick up a little bit next week and then start to level out again. That's just a lot of auctions coming up next week, a lot of supply. So there you'll be. My point is you'll see a choppy ride down, but interest rates overall are going down as we see retail sales slow down. We see inflation coming under control. So all those things impact it, but they're going to come down, but it might be a choppy ride.
Right. So let's move on to mortgage applications because we're
Yeah.
seeing this right now. Mortgage applications jumped more than 10% last month. So that just came out in January 17th. So we're seeing mortgage applications going up, and Redfin came out and said homeowners are increasingly coming to terms with higher interest rates and aren't waiting to sell. So, and we're seeing a little bit of that also because we're seeing more inventory starting to come on the market. I mean, I'm seeing more inventory right now than I've seen come on the market in a while, which we're still super low on inventory, but definitely we have more. There's no doubt about it. And home buyers say their magic mortgage rate is 5.5%. We've been saying this for a while that, that is, if we hit 5.5%, we should see, buyers in the market. But there was a Redfin article I read about a few weeks ago that said that they anticipate housing prices not to really explode like they did before, maybe 2.5 to 5%. Seeing housing, I mean, Zillow says 6% right now. So they're looking at, even though rates will come down to 5.5, it's still going to leave a lot of buyers on the sidelines because our median income is now, a median home price now is still around $400,000. It hasn't gone down. Matter of fact, it's ticked up. I heard today on the investment news. So home prices are staying pretty steady because of inventory. New construction, obviously, we know that they've had some big incentives out there. There's still some left, but as rates fall down, I think those properties are going to start moving off the market, and those incentives are going to begin to go away more and more. And with that said, we are seeing that too, because I'm having a lot of clients calling me now saying, hey, we want to try to buy something now so we don't have to get into the rush when rates begin to fall this year. So even consumers who are buying homes are seeing this right now. So what's your thought on, what's going to happen here with as rates drop and you're seeing more and more people coming into the market?
Yeah, I know a lot of people on the sidelines just waiting for that opportunity. And you're right. I'm hearing, definitely, in the fives. I think it's like you say, Katie bar the door. I think it's going to be bring a lot of people off the fence because right now there's been a lot of pent up demand, is what I call it. It's like a dam that's backed it up because everyone's been in a lock in situation where they really don't want to leave their interest rate for something in the sevens, and now we're in the sixes. And FHA in the low sixes. As far as we're concerned, we're actually in the low sixes. So that's much more attractive than knocking on 8%. And so I think there's a psychological. Anytime you break through that level of going into the sevens, go into the sixes, and I think we go into the fives. And historically, that's an extremely good interest rate. And so I think that, you need to kind of compare, COVID was a one-off. That was a very strange situation where the economy was completely shut down and interest rates not only went down to zero, but actually were held there. In other words,
Right.
that puts mortgages in the 3% range. So we now know if interest rates get crashed down to zero, basically banks can borrow for free. That puts mortgages right in the 3% range, unless we have something catastrophic happen, like a black swan event, which I would think COVID would qualify for that. I think
Right.
that we don't anticipate anything near that. And so, but if you look over the last 70 years, you're looking at interest rates, somewhere in the sevens is kind of the norm. And so
Right.
I think you need to
Well, we
keep
were in
that
the
in picture.
fours. We were in the fours for a long time, but what this did to the country, leaving rates low like that, has really made the housing market unaffordable for younger people right now.
Right.
And even it takes six figures to buy a home right now, and the average buyer is spending 38% of their income on their mortgage, which 30% is kind of the number where you want to not pass that. So that's an affordable market. We're in an unaffordable market right now. So there's got to be something that changes. So, let's talk about that. There's been some new loan limits and credit changes to FHA. Why don't you talk a little bit about that? Because a lot of people right now, especially if you're trying to get in the market before the rush comes, FHA is a little bit lesser mortgage rate. It's a little easier to get into. You don't need the highest credit score to get into it, and you're going to refinance anyways down the road. So, if FHA right now is a good
Yeah.
good way to get into a home.
It's a great way for a first-time home buyer to get into a home. Very forgiving as far as credit, like you were
And
mentioning.
let's talk about that though, because it's not just for first time home buyers. If
No, it's
you've owned
not.
a home before and you sold that home, you can use an FHA loan again to buy a home. And we're seeing a lot of that right now, where people have excellent credit scores and they have 20% down, but they're going FHA to get the better rate.
Right, getting a better rate, and as far as the debt ratio, things like that, it's more forgiving that way. It's more forgiving on the credit. At 640, a 640 FICO score, we call that elite credit. Elite, not
Right.
780. It's 640. We're there. For conventional loans, elite, it typically is at 740 or 760 depending on the lender. So you're getting the best interest rates available with a 640. We'll go down to a 580 FICO score with just 3.5% down. And so that's a really low interest rate. In the mid sixes probably for something in that ballpark right now, which is an incredible interest rate. Not only that, but below 580, it's a per AUS. And what that means is if the computer approves it, we have no credit overlays. We're not like a bank or a credit union where they'll add qualifiers on top of it. If we get a computer approval, we're good to go. So FHA technically would go down to 500 FICO score, but typically there are significant credit events that would cause it to go that low, that would disqualify it. But we run AUS all the time and get loans approved, below a 580. You're looking at about 10% down in that scenario. Again, the debt ratios, you were mentioning 30% is where you like to see it. And right now we're about 38, and FHA approves up to a 55% debt ratio. So it's very forgiving as far as debt ratio too. So if you have a cash gig or something like that on the side, you
On the
you can
side,
afford to.
right, or your
Yeah.
wife or your husband
Yeah.
is
Mhm.
1099,
Yep.
this can really work for you.
Absolutely. So there's some creative ways to get
Because
into a
I
home.
always want to say it out straight. If
Yeah.
you're going to be at 55% on your home and you're trying to carry that on your own, I personally would tell you not to buy a home right now.
Right.
Just that just not a good decision. And my son, in Orlando's making six figures, and that's where he would be on a mortgage, even with my help. And
Mhm.
it just doesn't make sense for them right now. So again, we go back to where we were last year in one of our videos. I spoke about, I really think that the government's going to need to come out with a loan to help young people get into homes, because they really need a first time buyer loan. your first home. This is your first home. You need to be able to purchase that home, or, you know, like this we're doing here in Florida. If you haven't owned a home in the last 5 years, you can get this mortgage, and they're going to have to do something, and taxpayers are going to have to help out. I mean, there's just no way around it, to help, you know, young people get into a home. And I know, like, we waste money on everything, but this would be something that would be good for the economy, good for people, and good for our country, because home
Yes.
ownership, a lot of young people have just given up on it. And that's why we're seeing a lot of this spending going on in the market right now, because young people have, especially Gen Z and millennials, have just said, you know what, I'm never going to own a home. I might as well go
They're
on
giving up.
vacation, enjoy my life, and spend the money, because I've been sitting here
Yep.
saving all this money to buy a house, and, you know, I just can't afford it.
I have that conversation several times a weekly where people are said, you know what, I might as well spend my money, might as well enjoy my life. And that's kind of a typical attitude. You know, young people in their 20s and 30s, they're just getting discouraged. And so I agree with you. There's got to, you know, there has to be some type of solution. And I don't know what that is, but there's got to be some type of way to help out with that first home, especially building equity in something. I was sharing, I just went to a closing this morning. This young lady, she's 25 years old. She bought a $450,000 property. And my first property was $44,000, you know, 10 times less,
Right.
and about the same age when she, you know, when she bought hers at the time. But that home is worth, you know, almost $500,000 now. And so it gives, you're building equity in something. And that's what she, you know, it's a really tough thing to
Yeah, I mean,
decide to
but
do.
you look at that. My first home was 300,000 here in Jupiter,
Mhm. Right.
and, you know, my mortgage rate was 9%.
Hmm.
But
Right.
the house price was so much less. Now we're looking at high interest rates and high prices
Yeah.
across the country, and it's a real problem for truly first time buyers. FHA
Hmm.
is not a true first time buyer program. It is a way to buy a home easier, and you can, you know, you can
Hmm.
only own one home. So
Right.
yeah, so I really think that, you know, that's going to be something that is going to be one of the things that I'm sure millennials and Gen Zers are going to, that are professionals, are going to be looking at, or have families during this election season. So we'll see what happens with that. Hey,
Yeah.
so
Yeah.
anything you want to add after?
Well, I'll tell you what, you know, as you know, Lee, I lived in California for 23 years, and I was always of the opinion that, you know, prices can't go any higher, because when I first moved there, the home I paid $45,000, 44.5 for in Ohio, you know, would sell for somewhere in the 500 range. In California at that time, I thought, my goodness, the prices here certainly can't go up, but they certainly have. And so, you know, when you think it can't happen, what happens is people just get really creative. They start renting rooms out. The loan programs change to use Excel, you know, auxiliary units, dwelling units, and that type of thing. So there's always a way that bank statement loans, self-employed loans, gig worker type loans, where we look at bank statements versus tax returns. So it's they basically find a way to get into a home. Down payments paid by gifts through family members, parents, that type of thing. So there's a lot. People just get more and more creative. Lenders get creative because lenders want to lend. They have to survive.
Right.
So they get more creative. So I would encourage people, you know, if there's a way to get into something like you say, I would never put something in a loan that they certainly struggle with, because you don't want the house to own you. You want it the other way around,
Right.
you know. So but the close you went to this morning was wonderful. She went on a bank statement loan. She's an artist, and she does incredibly well, and does weddings. I mean, just beautiful work. Very talented. And so but she doesn't have the in the box requirements, because, you know, she doesn't have too strong tax returns yet. So but her cash flow is very good, so it's a make sense loan. She puts a little more down, she has great credit, and we're able to get that loan. And she files a tax return here in April. She'll be full documentation and refinance and drop her rate almost 3%. So, you know, there's creative ways to help people get into homes. Reverse purchases, we've talked about that, Lee. I think we're working on
Right.
a
We've been
couple with
doing
you.
those. We've been working on a couple of those reverse mortgage purchases. Yeah, those are
Yeah.
great for people that are moving, you know, from one house to another, and they've got
Yeah.
lots of equity in that home. They can buy the new home, and get into it. So yeah.
Yeah, well, there's creative solutions, and then never have a mortgage payment again. You have to be over
Right.
62 years of age. But and when people retire, they're moving up from the Northeast, typically along this this seaboard here down the eastern seaboard. We see people retiring, their income drops, and then it's hard for them to qualify, and then they have to buy it as a second home. And there's all these gymnastics where if they just have the down payment, they can go buy a home and never have a mortgage payment. So they check that box, that's
Right.
why they want to pay all cash, but then they don't get the home they necessarily want. Their home that was 400,000 when they decided to retire to afford it 5 years ago is now 650. And
Right.
so, that's a problem. And so their planning was there, and now it just doesn't work. But if they put that, $300,000 down, they can get that same 650 home if they're, if the numbers work and not have a mortgage payment, still accomplish what they wanted to do.
Right. It's a great
It's neat.
program. It really is. It's really helped some people here lately. And I really appreciate you doing that, because it's gotten a couple of our clients in homes that they never thought. We have one closing on the 1st that she never thought she would ever own something as beautiful and as big as she's about to buy. And it's just worked out perfectly. So
Awesome.
look, Brent, thanks a lot. If you want any information from Brent, our information is right there on the screen. You can reach out to him directly. He would love to talk to you if you're planning to buy, if you're looking to buy now, if you're looking to invest now. Brent is your guy to go to. He works really hard for his clients, and he puts deals together that no one else can. And we see it every day with his builders that he's working with, where they're flipping him deals that they can't even touch, and he's closing on them. So he's definitely a great resource. And Brent, you're always willing to answer questions. If someone's not ready to buy right now, you're willing to work with them and help them and give them advice. And if you need a little credit repair or something like that, Brent will put you in a program, help you get that done, so you're not getting ripped off from one of these credit repair companies. So definitely reach out to him. And I hope everyone had a wonderful holiday. I know it was a really tough year for a lot of people last year. We have a lot of friends that had some really tough years, and we want you to know that we are our thoughts and prayers are with all of you out there for 2024 to be a great year, and for you guys to prosper as much as possible. So if we can help you, please reach out to us. Brent, thanks a lot for joining us.
Thank you, Lee, and it's so good to have you back. I can't tell you, brother, how nice it is to have someone to call.
I'm glad to be back, man, and I'm ready to go this year. And we're going to have some really great things going on with the channel this year. So we're going to try to add some different stuff to it, and so that we can provide more information of what it's like to live here in Palm Beach County, in the Treasure Coast, and in the great state of Florida. So be looking out for that stuff. Thanks a lot, Brent.
Thank you, Lee.
So I hope you enjoyed the video. If you did, don't forget to give us a thumbs up. We really appreciate it. And also, if you have not yet subscribed, go ahead and hit that subscribe button right there. Ring that notification bell so you don't miss any of our real estate tips and tours, and learn more about what's going on in the new construction market right now, because there are some amazing incentives still available, and you can do that right there. Be kind to each other, and I'll see you in the next video.